CROX, the maker of that popular clogs, actually had its shares run up yesterday, which I think is just in response to the share price declining as much as it did the previous day. And it's kind of like welcome news, at least for me, because I did build a position early yesterday. So the fact that it's already in a profit, or a pretty good profit, is very healthy, at least as far as I'm concerned, for the portfolio. And so what I want to do today is walk you guys through an analysis of the at the money, very long dated cash secured puts and covered calls, which you will have access to with the options yield tracker. I've populated everything for you guys already, and you can get that in the description. And so as you guys smash that like button, let me run that intro. What's up, my finance felines who always seem to drop meows in that chat? Let's dive right into this one. So we had a really good ending to the week where the stock actually jumped 6% after dropping almost 15% the previous day. But you can see that, a trailing 12-month PE ratio still suggests that the company's somewhat cheap, I would say, at 11 times earnings. But of course, that involves a belief set that you believe that the earnings are sustainable. Sometimes these low PE ratios are just falling knives and the E is going to get cut from under you. And so that's the one thing that I try to really spend a lot of time doing analysis on. And if you guys want that analysis, or at least my opinion and my interpretation of everything that's been presented to us as investors, you can go into the previous video, which I will link in this video. But nice to see that the stock has already run up, especially considering that I was selling it at the lower price. I actually did a covered call, so it's nice that it's gone up so much. Now let's dive into it. I made this as big as possible for you guys. I know some of you guys like to watch this while you're working out. I'm sorry if the numbers aren't large enough, but I will state them just to sort of help you guys out. So generally what I like to do is I start my analysis with calls and puts by going very long dated, and I work my way backwards. And we can see that, of course, the share prices are trading at $108. So, like call it an at the money at 105. Well, you can see that you're getting a premium for the covered calls at around $30 per share. Call it $30.50, kind of in between the bid and the ask. And let's do an analysis of that and see where we get to. But before we even start that, now that we have the premium and the exercise price and the date, let's go and see what the valuation is, because that of course helps us do our analysis. And so you guys may recall the valuation hasn't changed from the previous video. I mean, it's only been a day, but I'm using a terminal multiple of 15 times earnings, a terminal discount rate of 11.5%, which might be a little bit low, a little bit high, depending on your risk tolerance. And ultimately, I'm getting to a valuation of approximately $190 per share, which penalizes the valuation for the debt that they have on their balance sheet. Recall, guys, that they are aggressively paying down the debt. So as the quarters go on, as they're using that cash to pay down the debt, the excess cash, the negative, will get lower and lower, which will, of course, increase the valuation. And so this covered call analysis document is actually available to you guys for free. I've already pre-populated all of these numbers, so you guys can actually get this model in the description in this video. It's called a free options calculator. I just give it to you guys for free because I want you guys to sort of understand and learn how this all works. But you can see I've populated the ticker, the date. Basically, you just have to update what's in the blue. So you can actually hit file, download, and then just mess around with it on your own. And so, there's the ticker. I've updated that. NYSE is the exchange. The date, January 17, 2025, is what we just saw, the strike price and the premium. So you guys saw all this. The company doesn't actually pay dividends, so I just put 0 here. And of course, from today until January 17, 2025, it's 538 days. This helps us with the annualization of the yield. And you can see that, the premium plus actually the capital loss, because you're losing $3.14 because you are effectively buying the stocks at 108.14 and then you're selling them if you get assigned on them at 105. So you actually take a loss. And so your total return is $27.36. So what is this situation? What happens here is you've bought the stock at 105, you sold the covered call, but as the exercise date hits, the stock is actually selling for higher than 105. So you actually lose, you actually lose the stock that you purchased at 108 for the price of 105. You're compensated with the premium, but of course there's an ultimate loss here. So you don't take that full premium. You're taking a little bit of a loss ultimately on this, and so that's why you're making 27.36, not the 30.50. But what does that reflect? Well, it's a current yield of 28%. Annualized, it's 17.16%. And so that's what the annualized yield you can lock in for the next 1.5 years, assuming that the stock trades above 105 by the end of this term. But of course, this is your cash yield. And, the only difference between your cash yield and your annualized yield is that the annualized yield takes into account the capital loss that you sustain. So your cash yield is not 19%. You have to take into account capital gains loss. And so it comes down to 17.16%. Now, the question is, what happens if you're not assigned? What happens if the stock is trading under $105 as of January 17, 2025? Here's where options make the most sense for value investors. The whole idea here is to not make premium income. The whole idea is to be compensated for deploying capital, but the major point is that you're reducing your cost basis if the share price declines. And so you're taking care of your downside risk. This is what I always focus on as an investor. I do not focus on making as much money as possible. I focus almost exclusively on losing as little as possible. And I find that just not losing as much as other investors do helps me outperform. And so this is the second part of it, which is what happens if the stock price is trading under $105 per share as of the exercise date. Well, what happens is your cost basis actually becomes $77.64. And so how do you get to that number? Well, you take the price that you paid for the stock less the premium that you generated. And also, if they've paid out dividends throughout that term, that technically does reduce your cost basis as well. I consider it an element that reduces your cost basis. And so, of course, there's no dividends here, so it's just a zero. Some of you guys might look at the dividends and say, look, that's not reducing your cost basis, and so I will not take that into account. All fair. You can do that as well. I just do it the other way, but you can do it any way you want. But ultimately, your cost basis comes down to $77.64. You still own the security. So all you did was you just generated premium, but you get to hold on to the shares. But what does that really mean? Well, it means that if the EPS run rate is $12 a share, which in 2025, I'm forecasting that the company's going to make around $12.13. So call it $12. The $12 divided by your cost basis is what gives you $15.46. So heads, you lose the shares, but you made 17%. Tails, you get to keep the shares, but your cost basis gets significantly reduced. And so you have a perpetual equity yield of 15.5%. In this situation, when my equity yield is this high, and I'm holding onto the shares, that what I would probably do is not look to sell these shares for a long time, especially considering that the equity yield is growing every year. And I know that this company is very shareholder focused and they will be buying back shares. They will probably institute a dividend, et cetera, et cetera. So this is where it becomes a very interesting opportunity for me with this high of an equity yield. And, the market would have to give me a substantially better opportunity for me to give up this type of opportunity. And so, best case scenario is I get to hold on to the shares while generating this premium. I think that's largely best case scenario for most people that sell covered calls, but also worst case scenario, you're still being compensated for your time and to lose those shares, because over that 538 days, which is a year and a half, I've annualized 17.16%. So, either way, I'm good. And you're really, really locking in, or you're taking care of your downside. Now, obviously, what do you lose? Well, if the shares run up to $200 per share in 2 weeks from now, well, you're capped at that 105 and you're capped at that 17.16%. But I'm happy to cap the upside so long as I'm taking care of the downside. And that's just how I operate. That's why I use stock options as part of just being a value investor. I am completely comfortable in an environment where my portfolio is only increasing between 12 and 17% a year. And you know what? That's how I forecast everything out anyways. I think that's a more than reasonable rate of return. In fact, I would say that that's on the high end anyways. Even if I were to get anywhere in between 10 and 12%, more than comfortable with that. It just so happens that over the last few years, it's been a little bit higher, but I'm not a nut. I do realize that, just because you've been outperforming for a little little while doesn't necessarily mean that you outperform over the long run. And so I try to stay humble. I try to accept the fact that I'm a mortal and I can make mistakes, especially in my analysis. And so I do not allow myself to sort of think that I know what's going to happen or transpire. And so I continue to invest with a watch my back mentality first. I watch my downside and I'll just continue to do that. Now let's look at the cash secured puts. So same exercise date. And you can see that I'm using the same price just for comparability purposes. So $105 exercise price. Notice that the premium's lower. With the covered calls, the premium was actually a little bit higher. Part of this is because when you sell a cash secured put, you just put that cash aside and it actually generates interest in this environment. And so I will show you how those two sort of converge a little bit. And so you can see here that I just put in 5%, which is the money market rate right now. It might be lower or higher depending on or what brokerage you have access to, et cetera, and what securities you feel comfortable with to generate a money market return. There are ETFs that allow you to do that. They pay monthly, et cetera, and so you can you should change this to what your situation is. And so you can notice that with the cash secured put, you're actually getting a better annualized yield at 17.92% versus the 17.16% for the covered call. And that, I believe, is primarily because of the capital loss that you're taking on the cash secured put, or sorry, the covered call. And that's okay. But notice that the net purchase price for both options at $77.26 is virtually identical once you take into account the interest income that you'd earn on the cash throughout the term for the cash secured put, and which I personally view as equivalent to dividends that you would earn on a covered call. And so you can see here, this cash interest earned is the cash that you'd be earning on the money set aside. And so ultimately, the equity yield would be around 15.5%, which is the 12 divided by the 77.26. And of course, the way that you get to the 77.26 is you take the strike price, you subtract the premium, but then you also subtract the cash interest earned. And so now comes the question, why would I choose the covered call over the cash secured put? And the reason why I would choose the covered call over the cash secured put is, despite everything kind of being virtually identical, but you just get a higher annualized yield with the cash secured put, what I worry about is that the money market rate could come down substantially. First of all, my broker doesn't allow me to get this high of a yield anyway, so I'd have to kind of like search and find a solution, because I think right now I'm at around 4.4%. So I'll try and find a solution. I think that takes about an hour of research and I'd be able to get to that 5%. I'm sure it's possible. But the other risk is that the money market rate can actually come down if interest rates decline. Now, this is not a long enough time horizon where I think that's going to be a significant risk. However, it just happens to be what I decided to do. I don't really want that interest rate risk. However, what you kind of got to look at is how much interest rate risk there really is, because you have 17.92, so I'll just do that quickly, minus 17.16. So you would have to have 3 actions almost immediately to reduce the interest rate by 76 basis points for these to pretty much be equivalent. I don't think that's reasonable. And so I think over the term of the cash secured put, you actually generate a little bit more income. So despite the fact that I chose the covered call, in hindsight, when I look at this, it actually probably would have made a lot more sense if I did the cash secured put. But, based on what I was earning, I don't think I'd get 17.92. I think I'd get something closer to the 17.16 anyways. And so at the end of the day, it doesn't really matter. And that's why I chose to lock in the cash, the covered call. But you guys let me know which opportunity works best for you. Now, the other question that I always get is, why don't you just take a lower exercise date and generate higher a premium on an annualized basis? And the reason why I take higher, longer dates is because, from a long history of sort of like doing these things, that the premium and I guess the stock fluctuates significantly, and so you might be able to lock in something that makes a lot of sense for your upside and your downside, but you're limited just in terms of that window that you're able to lock it in for. So you might lock in a 3 month, and on an annualized basis, you get a nice premium, and it definitely covers you on the bottom side as well, or the bottom end. But the stock moves, and you may not have been able to lock in subsequently to that, and so you have to find another opportunity. So this is why I like to look at long dated. If it makes sense, if it exceeds my thresholds of, I like to see around a 15% annualized yield for the premium. And then I like to see an equity yield of around 15%. But once again, I would take a lower equity yield if I pretty much assured that or reasonably assured that the company will continue to grow at a high rate. And so the summation of the growth plus the equity yield is substantially higher than 15%. I'll take that as well. And so, it's all just to cover the downside, and it's up to really you guys how you want to do it. But this is why I choose longer dated securities or longer dated options contracts. Now, the other thing that I do want to remind you guys is I did show you the model for CROX. The question is, how do you get access to it? And you can actually get access to that whole model and all of the other models that the Patreons get access to at this lower tier. And, you'd be joining over or about 200 people on the Patreon as of today. And so, that I think that this is probably the best value on YouTube. And, if you guys are unsure if the value is there or not, just go into the comments and you'll see, there's quite a few people who are a part of the community, and they're always commenting. So if you're interested, you can just throw in a comment and just ask the other people who are watching this video to see if it's actually worth it. And so if you missed that last video on CROX, I know some of you have, you can actually get access to that whole video where I do that full analysis right here.